What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What is up, everybody? I'm back with another edition of the Macro Insights podcast, where I will be having a great conversation about the current market conditions, the overall macro environment, Jerome Powell and the Fed with John Davi. But first, big shout out to my sponsors. First one being Pleb Lab. So if you're down in Austin, Texas, go ahead and check out Pleb Lab. It is a co-working space with some of the best developers in the game. You can get in there with their lightning door. You can scan and use a couple sats to enter into the facility and go ahead and say what up to Carr and the fellas. But if not, if you're like me and you're not in the Austin area, go ahead and check out the Nomad Pass at pleblab.com. You'll get access to all their internal communications, the private events, and when you're in town, you can pop right in. So go ahead and get one of those Nomad passes. I have one myself. It's 100% worth it. I get to bug Super Testnet and a bunch of these other developers and just ask them a shit ton of questions, all because I got the pass and I have access to these guys where they might be getting bugged otherwise. So be sure to check out Pleb Lab, check out the fellas, and go ahead and snag yourself a Nomad pass. And then shout out to Idaho Armored Vaults. They are the best way to get access to the precious metals market. Bob Coleman and the team have been doing this since 2008. They allow you to protect your financial assets and private property outside of the financial system from numerous risks, including systematic and counterparty risks. They are also uniquely vertically integrated, and they allow you to not only purchase, but also have immense amount of liquidity, so you can buy and sell the precious metals at the blink of a hat or at the drop of a hat. So be sure to check them out at goldsilvervault.com and tell them Green Candle sent you. All right, now I got a very special guest in the waiting room here. I got John Davi. John, how are you, man? How you doing?
Good. Thanks for having me on.
All right. Well, for those in the audience who don't know you, why don't you give us a little bit of your background and how you got to where you're at today?
Sure. So I have been working in finance for about 23 years. Started out as an analyst in Merrill Lynch quantitative derivative research in 1999, 2000. Spent 10 years at Merrill Lynch, and then I subsequently went to Morgan Stanley working in the ETF product group. It was a content role. So, most of my career has been spent kind of like working on the ETF ecosphere, portfolio construction, looking at macro, kind of top down, broad market. Never did like individual equities, individual bonds. So always very much with a quantitative kind of macro perspective. About 7 years ago, I started Astoria Portfolio Advisors. We are an institutional asset manager. We manage money on behalf of other financial advisors. We oversee about 1.4 billion in total assets. Our firm launched PPI, which is an inflation ETF, in 2021. That's exciting news. So we typically put out a lot of content. If you go to storyadvisors.com, you'll see all our kind of macro research, our portfolio construction views, and looking forward to today talking to you about it today, Brandon.
Yeah, for sure. So, I mean, we'll just dive right in, right? I mean, you have an ETF on inflation, right? PPI and everything else. You put out a lot of content. Obviously, I've kind of indirectly met you through Twitter Spaces, and yeah, I mean, it seems like there's a lot to talk about when it comes to the overall macro environment. So, for somebody who's been in the game for such a long time, has seen, some waves come up and come down. How would you describe, I guess, where we currently are in the overall macro environment or business cycle, however you want to get into it?
Yeah, and I think that you just mentioned like the macro business cycle. I mean, that ultimately is like a big component into like our portfolio construction process. We do look at earnings and valuation and sentiment, but those are the buckets. So it's where are we in the cycle? What do earnings slash valuations look like? And then what is position and risk sentiment? And I think, I don't feel good about the macro cycle. I mean, a lot of the indicators, have been slowing for a while. Some of it looked like it, a little bit troughed. Things like, GDP, housing, manufacturing of late. Um, but there's things like leading economic indicators, the yield curve's inverted. So that, kind of is very troubling, very troubling. I think where the picture looks a lot better is things like, Europe and Japan, which are much further behind the interest rate cycle, the inflation cycle. So I think you got bifurcation in the macro kind of cycle. When it comes to like earnings slash valuation, I think what we learned from this past earnings season is that, earnings weren't necessarily, as bad as feared. So I think that has helped the market. I still think that US equities, index are priced for perfection. Like they've got high earnings, the bar is set very high, valuations are high. So like, I think you have to be careful, right? Which is why we kind of tend to like more Europe and Japan at Astoria and non-index level kind of securities. So I think, the earnings and valuation is a lot, kind of, I mean, it's still bifurcated, but it's a little bit of a cleaner setup, especially once you start looking at, international markets where your margin of safety is a lot lower, is a lot wider because valuations are a lot lower. And then I think, sentiment, that's the one puzzle, that three-legged stool that I just described: earnings, valuation, macro cycle. The sentiment and positioning is just pretty clean, right? Nobody likes stocks, and the ones that do, like, AI, let's say. But so much money went into bonds, so much money went to cash, money markets. There's just this, view out there, like, why do I want to take the risk in equities when I can just click 5% and buy a T-bill? So that's a concern indicator. So that's kind of how we're thinking about things. Story, I just talked a lot, but we can take it any direction you want. But I think that's kind of how we're thinking about things.
Yeah, and that's a great kind of breakdown. The three legs of the way you guys look at things. But you mentioned you're not super confident about the overall macro environment, or you're not. I guess if you peek under the hood, right, you got potential increased unemployment. You've got a bunch of other factors that could open up and theoretically open up the floodgates. But it seems like as you kind of pointed out, the market isn't really reacting to that just yet, right? We've had Nvidia, a lot of tech stocks and other things like that kind of just take off. So in your eyes, is the market kind of I guess almost projecting or kind of anticipating somewhat of a pivot and things to open up, and in a sense just kind of being a little I guess irrational at this time?
I think, like, what's happening is that, like, so, if you study like the kind of profit cycle, the earnings cycle, so once earnings start to contract, which we are still in a profits recession here in the US, once earnings contract, people will buy growthier companies that can grow their earnings no matter what environment we're in. So that definitely is tech stocks. I mean, some of these businesses are just like the highest quality blue chip, things like, Nvidia, Facebook, Google. I think we're masquerading this AI thing, but in reality, it's just this rotation out of value into growth because the profit cycle is accelerating, and those tech growth companies can sustain their earnings growth. Now that we know the trajectory of interest rates and we know what the shape of the curves look like I think companies can, like, and that's what they did, right? Facebook, Google, they all laid off a lot of their employees. They shored up their balance sheet. It's not like all of a sudden in Q2 they said, okay, we're going to pivot to AI. Like, they've been doing this stuff for a while. It's this larger macro narrative about this rotation out of value into growth. So, look, I mean, interest rates are the ultimate equalizer, right? It allows you to compare all these different asset classes, whether it's stocks, bonds, you know, multifamily property. So, now that we know what the interest rate cycle looks like, I think like, you can project and make decisions, from an investment standpoint. And I think that's what's happened with tech stocks. Like they've proven that they can like sustain, the market environment with their layoffs. And now, people are kind of gravitating to the AI plunge. But I highly doubt AI is going to kind of save the economy from the recession. Um, so I think you have to be careful. And if you're going to increase risk in your portfolio, I would suggest doing it through, European equities, Japanese equities, and there's ETF tickers we can talk about to play those views.
Yeah, yeah, for sure. I don't if you want to dive into the ETF or to some of the tickers, be more than you're more than welcome to. But I guess you brought up AI, so I kind of want to talk a little bit more on that because you said you don't necessarily think that that's going to save the economy in a sense, and I agree with you, but in a counterpoint, in a sense, I think that we've seen a few different booms, right? We've seen the dot-com boom. It seems like everything was kind of the tech growth kind of stocks were booming from like 2010 to 2020 ish time. And then out of that, it seemed like, there was like the recent crypto boom where any company that was doing something related to crypto seemed to, get a massive evaluation. And now I feel like we're kind of getting to like an AI boom where every single company is getting into or like name dropping AI in their earnings and their stock prices are taking off. Do you kind of see it in that sense too, or do you think AI is one of those things that's going to stick around, and those who obviously do it well are going to be the winners in a sense, but it's not going to be one of these like boom or bust kind of run ups.
It's funny. A couple years ago, so AI again is not all of a sudden. It is a big buzzword now, but it has been a buzzword for a while, as crypto has been. And I said years ago that if I had to pick and choose, between AI with a company like Google or Facebook or Nvidia or whatever company is dedicated towards building better kind of AI over crypto, like I was much more bullish on like technology and artificial intelligence, particularly from the big bellwethers like Nvidia and Microsoft, just because they've got so much free cash flow. They can take these bets. They can, Microsoft can take 10 billion and put it into OpenAI and try and kind of combat Google with their search function. So like, yeah, I don't think it's a fad per se. I think it's here to stay, but the price of what you pay at, right? Like what price are you getting, you know, into, right? Like we own a lot of those companies that we've been talking about in AI, like Microsoft, Nvidia. It's part of our quantitative stock portfolios. So we've owned them for a while. Like so we're the beneficiary of this recent uptick, but I don't know if I'd be putting money now. If anything, I'd look be trimming just because I think, these things are at like nosebleed valuations.
Yeah, and I gotcha. And it does seem like that could potentially be the case with what's under the hood. But I kind of want to dive into the inflation ETF that you have. You don't have to necessarily dive into the full holdings or anything like that. But in a sense, there has been a very inflationary environment. We've had, CPI at, I think we just like cracked under 5 this past month. But, it's been all the way up to close to double digits for the past 6 to 9 months ish time. So, and people have really been feeling that pain. So, in the overall, I guess, like inflation aspect and how you look at certain companies or what to put in this ETF, how do you go about that? Are you looking at it more so of, I don't know, like consumer staples or something along those lines generally does well in an inflationary time? Or do you look at, I guess, a little bit more specific to what's going on in, I guess, each inflationary cycle or business cycle, so to speak, where, obviously when there is a recession, there is some winners and there is some major losers. So there's always some time to find some winners in the market. But, this could definitely be, one of those times that it can be pretty interesting with, the overall scenario that we have right now.
Yeah, that's a good point. I think that
Oh, John, I think we lost you. I don't know where
I
you're
see
at.
that like energy materials, industrial stocks typically do the best. Um, when you get elevated levels of inflation. Um, Financials are also up there in terms of like, the statistical relationship between like high inflation and relative performance. So, our fund, it is actively managed. I think inflation is a highly nuanced area. I do think that like you got to be active. It is a multi-asset ETF, so we're looking at things like, energy stocks, material stocks, industrial stocks, have an allocation towards tips, just because we think that can like buffer your portfolio volatility. And then, we'll have some precious metals in there, things like gold, silver, which also have demonstrated sensitivity to high inflation. So, it's a multi-asset ETF. It's about 75-ish% equities, 10-15% precious metals, and then 10-15% tips. And it's active managed. I think that's the key. So the fund, past performance on indicative future results. The fund was up 4% last year when the S&P was down 18. So it did give you that inflation protection. Inflation has come down this year. Obviously, S&P is being driven by these AI stocks and technology stocks. PPI is down about like 3 kind of percent today, but what's encouraging is that, like the market, we're filming this podcast on June 2nd after the non-farm payroll days. And, like the fund is up quite strong today, which is nice, and I think what's happened is that if the recession has been punted for now and it's going to be delayed, if there's, a softer landing, like I think that gives a catch-up trade for some of these cyclicals, which has just been beaten up. So like broad-based commodities are down, 10-15%. Any commodity that's very sensitive to China is down even more than that. The energy sector year to date, if you look at ETF flows, is down like 8 billion. The XLE ETF is down like, I think it's down like 8, 9, 10% year to date. So, and that's what you see today. Like, so markets are strong, and what's leading today is energy and material stocks. XLE, XLB, these things are up like almost 3% today. So, I'm encouraged by the price action. I think like the way we've always viewed PPI is that it should be an inflation protection. It should be in your alternatives bucket, 3 to 4%. From a very high level standpoint, Brandon, I'll tell you that like every portfolio was, and even now today is still dominant with tech and growth stocks, just because like the S&P market cap, I mean, just look at Microsoft. If you look at Microsoft, it is, Microsoft and Apple is about like 15% of the S&P. So, there's big concentration risks. So we're concerned with that, and we just think that like there'll eventually be, um, you know, a new market leadership in the next 3 to 5 years. Your portfolio should evolve and should have some, things like energy stocks, material stocks, where there's just not a lot of broad representation. So, we also looked at it, PPI as kind of like, it's an alternative, and it's a satellite position against your core, because your core is just so tech and growth heavy.
Yeah, and it does definitely seem like it is pretty, tech and growth heavy, obviously, in like the S&P 500. So it is, in a sense, good to diversify and kind of get away from that, because if something were to happen, obviously, those, although they have the highest swings up, it seems like tech volatility also can, hurt you in the other direction as well. But that kind of leads me to, I guess that the current market conditions. It does seem like there is a lot of, I guess, the narrative around the volatility in the market, right? You're seeing a bunch of, various stocks like shoot up, double-digit percentages in a day. And maybe it's just because it's getting more notice now, but in a sense, do you think that the overall, I guess, market volatility is, greater now than you've seen it in, I guess, years past?
I don't think market volatility. I mean, like the VIX is low, but like I think like what I'm concerned about is so much money went to passive. Like everyone wants to be indexed. Nobody wants to use active managers anymore, and there's like a little bit of lack of price discovery at times. So that's troubling because not only is so much money is passive and indexed, then there's like this rise of like momentum CTA trade, and so these moves get very exacerbated on the way up and the way down. So I'm just concerned about market microstructure more so than like volatility. I mean, like there's always going to be more volatility when you have like periods of like very elevated inflation or major kind of risk off periods. So I think VIX is going to be I mean, like VIX has been low for a while. There's also a lot of like, option overriding strategy, people selling, index calls against the S&P to try and extract. I mean, what was the biggest story last year in the in the ETF world, right? I'm square in the ETF space. The biggest is like this JEPI ETF took in like $20 billion of of inflows. It's an option overriding ETF. It owns, high quality stocks and it sells like index calls against S&P. Like that was the biggest story. So it just shows you like how much concern there is in the market, because when you sell calls, you clip your upside. So, I think that kind of says it a lot of what people think about the market.
Yeah, and that's definitely a fair point. But I kind of want to dive to that a little bit more about what people are kind of seeing in the market, because it's not only, I guess, them looking at the various tech stocks and kind of how those are reacting, but it seems like everybody's keeping a closer eye on the banking sector now, especially with the massive amounts of bank failures. Obviously, we had Silicon Valley Bank, and a few others that everybody I'm sure knows the name of at this point. But I'm curious on how you're looking at these bank failures, and maybe in a sense, like some of these companies that are holding their money or accounts in some of these regional banks. It seems like a lot of them are either like moving it to JP Morgan Chase kind of thing, or they're getting caught in the wind and potentially need to get bailed out by the Fed, or however I guess you want to kind of look at that.
Yeah, I mean, I think like, it was scary a couple of months ago, but like that systemic risk seems to be a lot lowered. So I'm not worried about regional banks, I mean, like credit is tightening, like lending standards are going to get tighter. It'll lead to less credit growth, you know, a weaker economy. So there's all these stats out about like credit lending standards and what impact that's going to do to the economy. So I was worried about, a couple months ago if there was going to be more of a systemic risk from like, Silicon Valley, but that doesn't seem to be the case anymore. What's concerning in general is how Silicon Valley was, I think, the 18th largest bank and basically went under in the span of like a week. That's very troubling. It makes you wonder why anyone should keep their money outside of like the big four banks, JP Morgan, Bank of America, let's say. So I think, my vantage point on that is like there's bigger fish to fry and more risk, more concern out there. So that's what I'm focused on, as the slowdown of the macroeconomy, where we are in the cycle, the high earnings risk in the U.S., rotating out of the U.S. into international markets. How do you get that portfolio in the next 3 to 5 years, which is going to look different from the last 10 years, which is all tech and growth? Everyone wants to buy AI, which is basically tech and growth, which is last decade's trade. So those are things that kind of give me more concern.
Yeah, that's fair. And that's definitely a fair point, on I guess repositioning the portfolio for what's ahead. And so that leads me perfectly to what's the next I guess kind of cycle there, because you mentioned AI being, I guess, the new tech and growth of the next 3 to 5 years. So I mean, you don't have to give away all of your secret sauce necessarily, but are there certain sectors that you're keeping your eye on for I guess the next 3 to 5 years that you think might have you might be able to find some alpha in?
Uh, so, I think like, tech is going to definitely like make everyone's life easier, more productive. I think the valuations for the AI stocks are just at a nosebleeds level. The broad-based like Russell One growth, which, it's not exactly just tech. I mean, there's other sectors in there. It's not too concerning, the valuation, like the P ratio, like kind of low 20s. Um, these things were like at 30, 35, some time ago, before last year's meltdown. So I just think like, if I'm going to increase the risk of the portfolio, which is something that we've tried to do this year because we were pretty, we had like a lot lower beta than the market. And we've tried to think about other ways to kind of increase the risk, increase our beta. So whether it's add in like, things like, mid cap, add in international equities like IHDG, Japan is an interesting place, right? Nikkei's, 30-year high, DXJ is an interesting ETF to play that. We're trying to figure out other ways to kind of get risk in a portfolio and just play the momentum in the sense that, there's now going to be a chase, right? Like we're arguing for a chase at our firm, which is like, okay, the S&P is up 10, up 12, but it's all seven stocks that are driving that. So the equal weight S&P is probably flat to now up one or two, depending on, what happens today, how we close. But, like how do you get risk and play momentum if we're going to now be in this like green light zone for stocks, which I think there will be because now debt ceiling is under control. We talked about systemic risk with banks under control. So yeah, I mean, the view that we have is like, let's get risk in the portfolio, but let's look at it through things like international equities, or if the recession really is punted down the road, then I would say, we would, kind of think that you should take another bite at the apple for things like PPI, which is down 3-4, things like BCI, the broad-based commodity ETF, which is down 10, energy equities down 8 or 9, things that have not benefited a lot from this year because everyone thought we were going to go into a deflationary risk-off environment. So if that's not the case, then there should be a catch-up trade. And I'm encouraged with today's price action with what we're seeing with these cyclicals outperforming.
Yeah, and I mean, it does definitely seem like it, the recession in a sense has been almost like punted down the road. I kind of like the way you worded that, and I want to dive into that a little bit more because, it seems like the narrative around the Fed or Jerome Powell, whenever he gets up, is like continuing to raise interest rates higher for longer, more pain ahead, that kind of thing. But it seems like the market's been essentially screaming for a pivot for the past few months, and people, I guess you would probably know just as much as I do on these Twitter Spaces and everything else. Like everybody's screaming for it or doesn't understand why Powell continues to raise rates. I guess in that sense, do you think that Powell is going to, I guess, continue this trend to raise rates and I guess it's theoretically cause a recession a little bit earlier, or do you think maybe the act of pivoting or switching up course or pausing to raise rates will essentially punt what seems to be ahead, or this recession that seems to be ahead, down farther down the road?
So we've been able to increase interest rates by 500 basis points in the last year, let's say, and the economy is slowing, but there's still a lot of pent up consumer demand. Although I think that's starting to wane. I think ultimately, like, we're gonna have to get to like 6.5, 7% on Fed funds for the economy to really kind of get to like 2% inflation. But I don't think the Fed's gonna do that. I think what the Fed does ultimately is say, look, we're gonna get this economy, slower. We're gonna get inflation not down at 2 to like 3, 3.5. We're just gonna live in a higher inflation world for a while. So I think they stop, like 5.5, 5.75. But they're data dependent, right? So as the data comes in, they'll see like, okay, can we go another 25, another 50 basis points? So I think it's like, it's fun to talk about, but I don't think anyone should be like making investment decisions based on like what the Fed may or may not do, like in 3, 4 months, because they don't know what they're going to do, right? It all depends on the data.
Do you think that there's an issue with that? Because, a lot of the data that they've mentioned, it seems like it's either like kind of survey data and it's backwards looking, right? I mean, like unemployment, that's seems like it's going to be kind of I guess, a reactionary metric, right? So, I mean, I know Jerome Powell, like he's got a very tough job and I do not envy his position one bit, but it seems like, the data that they're looking at, might be something where it's like, all right, the damage is already done. So you got to either reverse course quickly the other way to kind of, try to help or what. But, I think just because we're dealing with like, very like humans and the overall economy, it's tough to get one, current data, and two, the data is essentially like, you're backwards looking. So in a sense, do you think that mindset is almost flawed in a sense, or do you, I guess, is this just kind of like the best that we can do at this point?
I don't fault the Fed for being data dependent. They I don't think they should be forecasting anything. Um, they do talk and they have like an open source dialogue with the street. Um, I'm surprised they don't kind of. I mean, the market is basically calling bluff, right? There was Fed rate hikes priced in. Like when they kept on like pushing rate hikes, but the market was like calling bluff on it. It'd be good for them to kind of, um, I think listen more to the street. But I don't know, like it's hard to imagine in this day and age. Like, tell us what data you're looking at. Like, what are your indicators? Like, it still feels like it's a big guessing game with them, and I don't see why it has to be proprietary, to be honest. I think they should be like very free with, okay, here's what we're looking at. If this gets to that, then we'll pause. Like it's like this big intellectual debate constantly with the Fed, and I think they could be a little bit more markets oriented as opposed to just pure, economist and just data. Yeah. So that's my view.
Yeah, but I guess in a sense, the Fed is not supposed to be, I guess, making decisions based on the market. But do you think that, I guess, they in it? I mean, they are connected, right? The market, if the economy's everything's going well, interest rates are low. We saw like 2010. We had Davy Day Trader there on Twitter Live or Periscope or wherever it was, just essentially throwing out Scrabble letters at to get a ticker, and it would just keep shooting on up. So in a sense, like it seems like based on the macro environment, that's where you kind of have to, I guess, make your plays in the market. But the Fed theoretically isn't looking at the market, right? But in it, like, I guess this is a two-part question. In a sense, when obviously the market, everything's are going well, the Fed just kind of let everything just go, even though, obviously having an inflated interest rate or not a deflated interest rate at near zero, or essentially zero for that decade, was problematic. And then, on the flip side, like, the market is kind of, I guess, I guess melting up in a sense here towards the end of the year, or through the second quarter. And, it does seem like there is some like potential issues with the consumer now. Are all those issues causing like unemployment or anything else like that? It doesn't seem to be the case, but that is something that they're looking to get. So I guess this is kind of a long-winded way to say, like, I guess, why do you think that the Fed should start to take into account like what the market is looking at, and how people are kind of I guess analyzing the overall macro economy?
I'm not sure if I understand your question.
Yeah, I mean, I'm just asking, why do you think that the Fed should start to look a little bit more closely at the market to make these decisions, opposed to, I guess, some of the more data dependent ways that they've lined
I
up?
no, I think like they definitely watch the S&P, that's for sure. I think that's the problem is that like they're data dependent and they do follow the market, but I just think like let us know what models you're looking at, what are your indicators, and let us all get on the same page. Like, why is there a difference between the dot plot and what they say they're going to do with rates, where how many rate cuts are priced in by like the bond market? Like, there's no reason to have a disconnect. Is the point? So, just
I
it's
got
2023. Let's be transparent. Why does it have to be secretive? They're
you.
not a quant. They're not a quant hedge fund.
Yeah, well, I mean, I feel like at this point, like, they're not going to make any ways or be transparent in a sense, because then people will kind of trade off of that transparency, right? I mean, once people can kind of get that data, but I mean, that would also assume that markets aren't manipulated, when in a sense that they probably are, right? I mean, whether it's by the Fed or by some of the big hedge fund guys in a sense too. So but you said that you think that the recession's being punted down the road, so to speak. So I guess I'm going to put you on the hot seat here. When do you kind of see this, I guess, all coming to light, or do you see it kind of being, I guess, a soft landing, hard landing, no landing, that kind of aspect?
Here's what I think, Brandon. I think that you have rolling recessions across different segments of the market, across different points in time. I think last year was all about the long duration asset, which was screaming for a recession. Long dated bonds, horrific returns. Crypto, horrific returns. Disruptive growth ETFs, horrific returns. This year, it was, the regional banks, impacted by all the Fed fund increases. So I just think there's going to be pockets. The broad S&P is kind of hanging in there, so it looks like things are perfectly fine. But I know under the hood, there's a dichotomy, right? You've got, commodities which fell off a cliff, oil which is down quite a bit. So I think, there's parts of the economy that have crashed and burned, right? Long dated bonds, long duration assets last year, regional banks. I mean, some regional banks went extinct, right? Like that's huge, right? So I just don't know if like you're going to get like the entire S&P down again 20-25% like it was, like it was last year. So to have two back-to-back down 25% years is very, very rare. So
Yeah, and that's a very fair point, in a sense. But I gotta ask this before I let you go, or we like let you plug your stuff. You are named Astoria Advisors, and Astoria is the most densely populated area in the country of Greek and Greek Americans, and I am part Greek myself. So I have to ask you, what's your favorite Greek food spot in Astoria, and do you have like a go-to like Greek dish that you love to eat?
um, I would say
I have to
where
ask.
where where do you work or live out of, Brandon?
So
It's
I'm in
funny.
Tampa, and we have Tarpon Springs, like 45 minutes up the road, which is number 2 behind Astoria. So they always, every time I talk with a New Yorker that's down here in Tampa, they always make sure to tell me like, hey, if you want real Greek food, you can go to Tarpon, but if you want even better Greek food, you got to go all the way up to Astoria. So
Yeah,
I had
yeah.
to ask.
um, there's a place near Astoria Park called Agnanti, which is very good. It's where like the locals would go. I mean, it's touristy place. Kyklades, which is very good. I'm not Greek, um, but yeah, I did grow up in a very Greek community. It was very multicultural part of Queens, which is, that's New York City for you. It's very ethnic, a lot of different cultures and national.
John, I think we lost you here for a second. Oh,
Okay, I'm back.
you
Yeah,
are.
I'm
There
back.
you are. Yeah, but you were saying it's a very, I guess, ethnically diverse area. Well, that's New York City, and I guess America for you, right? I mean, but even more so in New York, right?
Yes.
Yeah. So, well, John, you've been very generous with your time and kind of going through, your mindset on the overall market, a couple of your ETFs, the inflationary time and all that kind of stuff. So, I really appreciate you coming on. Why don't you tell everybody where they can learn a little bit more about Astoria Advisors and yourself?
Sure. So AstoriaAdvisors.com is our website. You can follow me on Twitter at Astoria Advisors, and that's AstoriaAdvisors.com.
Awesome, and I'll put all that in the show notes as well as your Twitter handle. You didn't plug that in there as well. Is that just Astoria Advisors as well, or no?
That's my Twitter handle. Yeah, that's my Twitter handle.
Okay, awesome. So I'll put that all in the show notes as well. So everybody be sure to check out Astoria Advisors. And yeah, check out those Greek restaurants you were naming, dude. I'm getting a little hungry just talking about it. So
Yeah.
thanks so much for coming on. And
All right. Thank you, Brandon.